Stop scrolling. Close that TikTok. Tell whoever's talking to you that this cannot wait. If you're about to grab lunch, bring your phone to the table and put in your earbuds. Because what I'm about to reveal about the absolute chaos erupting on Wall Street trading floors in the last 72 hours is so urgent, so time sensitive, that checking your notifications just became the least important thing in your life. We need to talk about the emergency meetings, and I need you locked in for the next 12 minutes. For the last 3 days, my signal groups have been absolutely on fire. I'm getting panicked messages from private wealth managers in Manhattan, from commodity traders in Chicago, and even from regular folks who opened their brokerage apps this morning and saw something they've never seen before. Reports are flooding in from New York, from London, from Singapore, and the pattern is identical across every time zone. They are all saying the same thing. Silver is moving in ways that are breaking the algorithms. Now, if you've been watching the precious metals market for any length of time, you know that silver usually trades in a very specific range. It moves up a few percent, it moves down a few percent. The computers keep it contained. The big banks keep it under control. That's been the game for decades. But something happened 72 hours ago that flipped the script. Something triggered a response so violent, so unprecedented, that the institutional players who've controlled this market for generations are now in full-blown panic mode. Ladies and gentlemen, this is your host speaking, and we need to talk about what just detonated in the silver market. We're seeing specific names surface in the rumor mill: Goldman Sachs, JP Morgan, HSBC, and the internal communications that are leaking out. Because yes, people are leaking. They all contain the same keywords: containment failure, liquidity crisis, uncontrolled volatility. These are not the words you use when everything is going according to plan. These are the words you use when the plan just exploded in your face. Here's what we know happened. On Monday morning at 9:47 a.m. Eastern, silver opened at $32.15 per ounce. Normal, controlled, boring. By 10:30 a.m., it had touched $34.80. By noon, it spiked to $37.20. By 2 p.m., it hit $39.90. And then, in the final hour of trading, it absolutely detonated to $42.65 before they managed to slam it back down to $38.50 at the close. That's a $10 intraday swing. On silver, that doesn't happen. Silver doesn't move $10 in a month, let alone in 6 hours. But here's where it gets really interesting. The moment silver crossed $40, the entire financial media apparatus went into overdrive. CNBC brought out the experts. Bloomberg published 3 hit pieces in 2 hours. Reuters ran a story titled, "Silver Rally Unsustainable, Analysts Warn." The Financial Times called it a speculative bubble. And then, the phone calls started. Retail investors who'd been holding silver for years started getting calls from their brokers. Not emails, not automated messages, actual human beings calling them, using scripts, telling them this rally is dangerous and they need to protect their gains by selling immediately. One of my subscribers recorded his call. His broker used the exact phrase, "catastrophic reversal imminent," 3 times in a 4-minute conversation. Now I want you to pause right here. Take a breath. Step back from the excitement of seeing silver finally move. Stop thinking about your account balance for just a second and think like a detective. Ask yourself the single most important question in all of finance. Who benefits? Since when do the big banks care about retail investors protecting their gains? Let me take you back. When silver was at $18 and genuinely undervalued, did they call you? Did they send urgent alerts saying, "Buy now before it's too late"? When it was at $22 and breaking out, did Bloomberg run articles saying, "Silver, the opportunity of the decade"? No, they were silent. In fact, they were doing the opposite. They were publishing research reports saying silver was headed to $15. They were telling clients that precious metals were dead money. They were recommending equities, bonds, anything but silver. But now that silver just made the biggest one-day move in 15 years, now that it's threatening to break through multi-year resistance, suddenly they're your financial guardian angels. Suddenly, they're deeply concerned about your downside risk exposure. Ask yourself, why now? Why this urgency? Why are they so terrified of you holding your position through this rally? I'll tell you exactly why. This is not a concern. This is not protective advice. This is a trap, and it's born from absolute desperation. They are not calling to save you from a crash. They are calling because they are the crash. The big bullion banks are trapped in the single largest short position in the history of the silver market. And what just happened on Monday was not a rally. It was a margin call. It was the sound of their entire strategy imploding in real time. They need you to sell. They need your physical silver. They need your ETF shares. They need your futures contracts. Because if retail doesn't panic and dump their positions in the next 48 to 72 hours, the institutions are going to have to cover their shorts at prices that will literally bankrupt some of the biggest names on Wall Street. And the weapon they're using to create this panic, the event they're pointing to as justification for their fear-mongering, is the COMEX delivery deadline hitting this Friday. They're holding up this deadline like it's a nuclear bomb timer, telling everyone that the market cannot possibly deliver the physical silver that's been demanded, and that when Friday arrives, the entire structure will collapse, silver will crash, and everyone holding positions will get destroyed. But is that true? Is this really a delivery crisis that ends in catastrophe? Or is this the most sophisticated bear trap we've seen in the precious metals market in 2 decades? To understand what's really happening, you need to understand what COMEX is and how this delivery system actually works. Because the banks are betting that you don't understand it, and that ignorance is the weapon they're using against you. COMEX, the commodity exchange, is where silver futures contracts trade. Think of it like a marketplace where people make promises to deliver physical silver at a future date. When you buy a futures contract, you're essentially getting a promise that says, I will deliver you X ounces of silver on Y date. Now, here's the key. Most of these contracts never result in actual delivery. They're just paper trading between institutions. You buy a contract, the price moves. You sell the contract, you take your profit or loss, and no physical metal ever changes hands. It's just numbers on screens. That's how it's worked for decades. The physical delivery system is basically a formality that almost never gets used. But something changed in the last 6 months. Starting in October, we started seeing an unusual pattern. Retail investors and smaller institutions started actually standing for delivery. Instead of just closing out their paper contracts for cash settlement, they were saying, no, I want the actual metal. In November, delivery requests hit 15 million ounces. That's high, but not catastrophic. In December, it jumped to 28 million ounces. Eyebrow raising, but the system handled it. In January, we saw 42 million ounces requested. And then February happened. As of today, with the delivery deadline 3 days away, there are standing requests for 89 million ounces of physical silver. That's 2,768 metric tons. That's more than the entire registered inventory of the COMEX warehouses. Let me say that again. People have demanded more silver than exists in the available supply. This is not normal market behavior. This is not a glitch. This is a coordinated squeeze, and someone very large, very well capitalized, and very smart is systematically draining the physical market. Now, here's where the banks come in. JP Morgan alone is estimated to be short somewhere between 150 to 200 million ounces of silver through various derivative positions. That's paper silver they've sold without actually having the metal to back it up. They've been running this trade for years because it's always worked. They short paper silver, the price stays controlled, they cover at a profit, rinse and repeat. But this trade only works if physical delivery never becomes a real factor. It only works if everyone plays the paper game. The moment people start demanding physical delivery at scale, the entire structure falls apart. Because you cannot deliver what you do not have. And that's exactly what's happening right now. So let's revisit Monday. Silver opens at $32. By mid-morning, it's clear that the delivery requests are not being withdrawn. Institutions that were supposed to roll over their contracts into next month are instead standing firm and demanding their metal. The banks realize they have a problem. They have two choices: deliver the silver they don't have, or buy it in the open market to deliver it. If they try to buy 89 million ounces in the open market, the price will explode. Every purchase drives the price higher, which means every subsequent purchase costs more, which creates a feedback loop. That's exactly what we saw Monday morning. That $10 move in 6 hours wasn't retail FOMO. That was institutional panic buying. At exactly 2:03 p.m. Eastern on Monday, with silver touching $42.65, something happened that's only occurred 3 times in the last decade. Trading was halted for excessive volatility. When it resumed 15 minutes later, there was a wall of sell orders waiting. Within 90 seconds, silver had been hammered down by $4. By the close, it had given back nearly half the day's gains. Now, the mainstream media called this profit-taking and natural market dynamics. But let's think critically for a second. If this was organic profit-taking, why did it happen all at once? Why were the sell orders perfectly positioned to hit the moment trading resumed? Why did the selling stop exactly at a price level that kept silver from breaking its 2011 high? This wasn't profit-taking. This was a coordinated dump. The banks used the hold to organize a defensive response. They flooded the market with paper contracts, not physical silver, paper promises, to create artificial selling pressure and drive the price back down. And it worked for about 18 hours. Because Tuesday morning, silver opened at $39.20 and immediately started climbing again. As I'm recording this Wednesday afternoon, we're at $41.80, and the pressure is building like a coiled spring. Which brings us back to the phone calls and the media blitz. The banks know they can't hold this down with paper selling forever. Eventually, the physical demand overwhelms the paper manipulation. So they've deployed their final weapon: psychological warfare. They're trying to convince you that Friday's delivery deadline will be a catastrophe. They're painting a picture of COMEX default, market collapse, regulatory intervention, and a flash crash that takes silver back to $25 in a single day. But here's what they're not telling you. There's a buyer standing in the shadows that makes this entire crash narrative impossible. A buyer so large, so well capitalized, and so strategically motivated that any significant price drop will be instantly absorbed. We need to talk about China's solar manufacturing complex. Right now, China controls approximately 85% of global solar panel production capacity. Every single one of those panels requires silver. The average panel uses 20 grams. China is targeting 1,200 gigawatts of new solar capacity by 2030. That's 750 million panels. That's 15,000 metric tons of silver per year for the next 7 years. And here's the kicker. China's Strategic Metals Reserve has been quietly accumulating silver for the last 18 months. We're seeing cargo manifest from refineries in Switzerland and Mexico shipping directly to Shanghai. We're seeing Chinese state-owned enterprises bidding on every available lot at auction. This creates what I call the industrial floor. There is a price level below which Chinese buyers will simply purchase everything available. Based on their purchasing patterns, that floor appears to be somewhere between $36 and $38 per ounce. So when the banks tell you silver is going to crash to $25, they're either lying or they're delusional. Even if COMEX somehow defaulted and paper silver collapsed, physical silver cannot fall below the level where the world's largest industrial consumer will buy unlimited quantities. But there's more. Right now, the Shanghai Silver Exchange is trading at a $2.80 premium over COMEX. That means physical silver in China costs $2.80 more per ounce than paper silver in New York. What do you think happens when that spread exists? Arbitrage traders buy COMEX contracts, take delivery of physical silver, ship it to Shanghai, and sell it for an instant $2.80 profit per ounce. They do this over and over until the spread closes. This means any artificial dump on COMEX just widens the arbitrage opportunity. Every time the banks slam paper silver down, they're essentially putting physical metal on sale for the Chinese buyers. They're accelerating the very drain they're trying to prevent. This is the trap they've built for themselves. They're trying to use a paper market to control a physical shortage. And it's like trying to put out a fire by throwing gasoline on it. Now let's talk about Friday's deadline. Yes, it's real. Yes, there are 89 million ounces requested. And yes, COMEX probably cannot deliver all of it from registered inventory. But here's what the fearmongers aren't telling you. COMEX defaults don't cause market crashes. They cause price explosions. If COMEX cannot deliver the physical silver that's been demanded, they have three options. Option 1. Cash settle the contracts at current market price. This forces them to pay out billions in cash, which they don't want to do, but it doesn't crash the price. Option 2. Source silver from eligible inventory or outside sources, which means buying at market, which drives the price up, not down. Option 3. Default entirely, which destroys the credibility of paper silver, which means everyone rushes to physical, which again drives the price up. There is no scenario where a delivery failure crashes the price. The entire narrative is backwards. A delivery failure is bullish, not bearish. So let's bring this full circle. We've exposed the panic. We've explained the mechanism. We've revealed the protective floor. Now what do you actually do? Here's the situation. The banks are trapped with massive short positions. Physical demand is overwhelming paper supply. Friday's deadline could force their hand, and they're desperately trying to shake out retail holders before they're forced to cover at catastrophic prices. The phone calls you're getting aren't friendly advice. They're begging. They need you to sell your physical silver. They need you to close your ETF positions. They need you to give them the liquidity to exit their shorts before this turns into a full-blown squeeze. So here is my instruction to you for the next 72 hours. When your broker calls, and they will call if you hold any meaningful position, here's exactly what you do. Let it go to voicemail. Do not pick up. Do not engage in a debate about market fundamentals or technical resistance levels. They are reading from a script designed to exploit your fear. If you make the mistake of answering, here's your response. I'm holding. That's it. 2 words. No explanation, no justification. Just I'm holding, and end the call. Do not sell your physical silver. I don't care if they tell you it's going to $20. I don't care if they show you a chart that proves a crash is coming. Do not trade your ounces for their paper promises. Do not close your long positions in SLB, PSLB, or futures contracts. Do not take profits at $42, thinking you'll buy back at $35. This is not a trade where you can step out and step back in. When this breaks, it breaks fast, and you will not get back in at a better price. And whatever you do, do not short silver. Do not buy put options. Do not believe for 1 second that this rally is a bubble about to pop. You would be stepping in front of the single largest industrial commodity squeeze in modern history. Friday is the delivery deadline. Between now and then, expect maximum volatility. They will try everything to shake the tree. Flash crashes, media attacks, broker calls, margin requirement increases, every trick in the book. But after Friday, one of 2 things happens. Scenario 1. COMEX delivers. This proves the delivery requests were a bluff. The banks breathe a sigh of relief, and silver probably consolidates in the $38 to $44 range for a few weeks before the next leg up. Scenario 2. COMEX cannot deliver. This breaks the paper market's credibility, triggers a rush to physical, and we're looking at $50 within days and $75 within weeks. Either way, the trend is up. Either way, holding wins. But understand what this really is. This is not just about silver prices. This is about the final breakdown of the paper manipulation system that's controlled precious metals for 4 decades. This is about physical reality reasserting itself over financial engineering. The banks have played this game for so long, they forgot it was based on a lie. They sold silver they didn't have because nobody ever asked for delivery. But now somebody's asking, and asking in size, and the whole house of cards is shaking. This is a game of chicken. They're driving straight at you with their headlights on high beam, honking the horn, trying to make you swerve. But their car is made of paper, and your position is backed by physical metal. If you hold the line, they're the ones who crash. Be stubborn. Be the immovable object. The manipulators are bleeding. Every day silver holds above $38 costs them hundreds of millions in margin. Every ounce that gets delivered drains their vaults. Time is on your side, not theirs. This is not just a trade anymore. This is a wealth transfer. This is the silver of the desperate banks, flowing into the hands of those who understood what physical scarcity means in a world drowning in paper promises. Do not be the victim of the fear campaign. Be the beneficiary of their panic. If they manage to slam it down to $38 or even $36, don't panic. Thank them and add to your position. Because in 6 months, when we are trading north of $60, you won't remember Friday's delivery drama. You'll only remember whether you held your ground or whether you let them scare you out of the trade of the decade. The chaos is real, the panic is real, the squeeze is real, and the opportunity is real. This is breaking news, and we're living it in real time. The next 72 hours will be historic. Make sure you're on the right side of it. Stay strong, stay positioned, and I'll see you on the other side of Friday. If this analysis helped you understand what's really happening, hit that like button, subscribe for updates as this situation develops, and share this with anyone who needs to hear the truth behind the headlines.